Now, Singapore's economy has expanded 4.6% in the first quarter from a year ago. That's down from the 5.7% expansion in Q4. And advanced estimates show on quarter the economy contracted 0.3%, reversing gains from the previous quarter. And expansion was supported by increased activity in the construction and trade sectors. But officials have warned that the Middle East conflict may weigh on economic activity up ahead. And the country is also bracing for potentially higher inflation as the Middle East war drives up energy prices. Well, a support package of almost $780 million was introduced last week. Deputy Prime Minister Gan Kim-yong has warned that growth in the coming quarters is likely to be affected by the conflict. And he said that inflation this year is likely to be higher than the previous projection of between 1% and 2% this year. The country has forecast growth this year between 2% and 4% on the back of strong expansion in 2025. We also have the latest policy decision out of Singapore's central bank, and it has tightened monetary policy as the Middle East war threatens to lift inflation. The MAS is increasing slightly the rate of appreciation of the currency policy band, and there will be no change to its width and the level at which it is centered. Now, Singapore imports a majority of its energy and food, which could be made more expensive by higher transport and fertilizer costs due to the conflict. MAS manages monetary policy by letting the Sing dollar rise and fall against a basket of currencies, and a stronger Sing dollar could help make imports cheaper. We take a look right now at the Sing dollar 1.272 there to the greenback. Of course, bring you more market reaction when the STI comes online in the next hour. But for now, we go to Yun Liu. She's senior ASEAN economist at HSBC. So Yun, let's start off with the MAS's decision. So this was widely expected. It would tighten policy. Give us your read into the latest move. I mean, also whether you view this as largely preemptive, or are we already, starting to feel the inflationary pressures?
Thank you very much for having me. So yes, today the MAS decision to tighten its monetary policy through a slight increase in its Sing near slope here is widely expected. And in fact, after the January decision, we had already penciled in that tightening move to happen this April, before the Middle East conflict. And what has happened for the past 2 months or so, it very much just strengthens our conviction that the MAS would opt for policy normalization. I think here the main priority for the MAS here is really on inflation, and I would see it as very much a preemptive move here, because for now inflation, we haven't really seen that inflation impact really coming through the let's say core inflation. But let's also not forget that because Singapore it's imports a lot of the energy, food, and everything, so that imported inflation will very much rise or reflect in the core inflation computation here. So I think for the MAS, really trying to tackling that core inflation concern is very much the main reason for today's move.
Yeah, I think that the follow-up question is whether, we will see a back-to-back tightening move. I think you mentioned earlier in the CNN article that you don't expect that. But what could prompt the MAS to deploy another move in July, or perhaps a more aggressive one later this year?
Well, I mean, we have penciled in another tightening move, not in July, but in October. So we would expect the MAS to take some time and assess the impact of the tightening move before, probably deciding to do another tightening here. But I think one thing that we really need to keep in mind is on the growth concerns. I mean, I wouldn't expect the MAS to do more of the so-called aggressive tightening moves here, because let's not forget high energy prices. Ultimately, there is also a drag on the growth part. So for now, inflation is the main concern, but in the medium term, I think the growth part will really come into play in the equation as well. That's why I don't expect an aggressive tightening move by the MAS.
Yeah, but surely there are also concerns there to Singapore's export-oriented economy. I mean, that is also a key pillar. I mean, especially if global demand softens.
Yeah, I mean, it's not a concern for Singapore, but it's also a concern for all the trade-dependent economies, especially here in Asia. I mean, when I think about, the impact of high energy prices, especially to Asia here, the sequencing of the impact matters. Obviously, the very first chain of impact here is on inflation. We've already seen that in some ASEAN countries here who is so sensitive to the oil price spike here. But I think the second chain of impact then will start to talk about growth. For now, it looks like, some indicators, either trade, high-frequency indicators or industrial production, for now, it's still quite resilient, especially for Singapore here. And that AI-driven story continues to benefit, countries like Singapore. But the longer the conflict drags, if, this oil prices or energy prices were to persist longer, higher for longer, then ultimately it would also drag down on growth. And because Singapore is so sensitive to the global trade headwinds, so it's not going to be insulated.
Yeah, and you're just looking at the Q1 advanced GDP figures as well. So grew 4.6% on year in Q1, but quarter on quarter it contracted slightly. How should investors be interpreting, I suppose, this divergence between the annual resilience versus a shorter term weakness?
Yeah, I mean, if I look at the 1Q advanced GDP here, it's a downside surprise to my own forecast. But I mean, in terms of the Q-on-Q growth momentum, it's just a slight pull down of 0.3%. And I think that also reflects a sort of a natural and healthy pull down from the previous quarters, because for the previous 3 to 4 quarters, we saw very strong GDP growth from Singapore. And I always say that, Singapore, a DM market is growing like an EM market here. So I wouldn't read too much in the first quarter of GDP, just 1 quarter of pull down here. And in fact, I kind of see it as pretty much, I mean, Singapore pretty much started 2026 on a resilient footing. Then, but I would be a little bit more concerned about what's going to happen, especially in the second half of here, and the impact of high energy prices, whether that's going to disrupt, let's say, the global trade flows here.
Yeah, and I wonder what your outlook is for the full year. I mean, MTI said that, GDP growth remained resilient in the first quarter. The US, Israel, Iran conflict may weigh on economic activity in the coming quarters. So full year, I mean, what are you expecting to see?
So for full year, I mean, I think for the first half of this year, we should still expect to see some resilience in Singapore's economy. Then I have penciled in a little bit of headwinds to come more in the second half of this year. I mean, especially, let's say, if that high energy prices were to weigh down on trade, on global trade flows. But overall for 2026, my growth forecast is 2.9% for Singapore's GDP growth. And that sits in the middle of the MTI's 2 to 4% of growth forecast range.
All right. And just finally, we hear the government, I mean, recently announcing that $1 billion support package. So does this, I suppose, this fiscal intervention give the MAS more room to be aggressive with the exchange rate? Or do you potentially see it stimulating demand and then potentially complicating the MAS's job?
Well, I mean, I see it very much as complementary in a way. And I think when we look at the fiscal position that Singapore has, and when we compare that with other emerging markets in the region, Singapore is in a much better or much more enviable fiscal position than peers. If we look at budget 2026, there now, 2 weeks ago, the government has announced some front loading of the measures already announced in budget 2026. And let's not forget that for budget 2026, it's actually a quite conservative budget because it's the very first one in the new 2026 to 2030 fiscal cycle there. So it's budgeted to see a surplus of $8.5 billion, which is about 1% of GDP. So if needed, I think Singapore is still able to quickly deploy, let's say, a supplementary budget to introduce a bit more of targeted subsidies.
All right, you appreciate your time today. You're the senior ASEAN economist at HSBC.